Have you ever peered into, the latest financial reports from a big company and wondered what they really tell us about the economy, maybe about our own spending, where things are headed?
Right.
Today, we're going to try and peel back the layers on a real financial powerhouse, one that touches a lot of our daily lives.
Exactly. We're taking a deep dive into American Express, looking at their recent performance, their strategy, drawing straight from their Q2 2025 earnings call, and that detailed 10Q filing.
The 10Q, right, the big quarterly report with all the details.
That's a one. Way more depth than just the headlines.
Okay, so our mission today is basically to give you a shortcut to understanding, the pulse of consumer spending, the strategies Amex is using, and the challenges they're navigating.
Yep. Get ready for some clear explanations, maybe a few surprising facts, too. Should leave you feeling pretty well informed.
All right, let's crack open this vault of data then. Where do we start? The big picture.
Let's do it. Kicking off with the big picture financials. American Express reported pretty strong top-line numbers. Total revenues, this is net of interest expense, climbed 9% for Q2 2025. And actually 8% for the first 6 months compared to last year.
9% is solid growth.
It is. And what's really noteworthy is that this growth held up even when you adjust for foreign currency swings. So it shows real underlying momentum.
Right. It's not just exchange rates making them look good. That 9% jump, it really signals they're managing well, maybe even thriving compared to some peers. But one thing that jumped out at me was net interest income, NII, up 12% in Q2. That seems pretty significant.
Yeah, that's a big jump.
So what exactly is NII again, and what's driving that?
Good question. So net interest income, NII, it's basically the profit Amex makes from the interest they charge on card balances,
Yeah.
minus the interest they pay out, say, on deposits.
Okay. Interest earned minus interest paid. Got it.
Exactly. And connecting that to the bigger picture, well over half of that NII increase since 2019, it's come from just growing the balance sheet. More card member spending leading to more balances.
Makes sense. More lending, more interest.
But here's the really interesting part. NII actually grew faster than the spending volumes
How does that work?
because they managed to increase the margin they make on those balances. So they're not just growing the loan book. They're getting more profitable on each dollar loaned out. It's optimization.
That's a smart strategy, really focusing on profitability per transaction. Now, I did see, though, a slight dip in Q2 net income, down 4%, and earnings per share down 2%. How does that fit in?
Yeah, there's an important detail to unpack. It largely reflects a one-time thing. Remember, they sold Excertify back in Q2 of 2024.
Oh, right. I vaguely remember that sale.
Well, that sale created a gain, about 66 cents per share, actually. So if you strip out that one-off gain from last year.
Ah, then the comparison looks different.
Exactly. For the full 6 months this year, net income was basically flat, and the earnings per share, the EPS, actually went up 3%.
Okay, that makes a lot more sense. Really shows you need to look beyond the headline number sometimes. Understand the context.
Precisely. Got to look at the underlying drivers, not just one quarter in isolation.
Right, so understanding that full picture helps. Now, with those strong top-line numbers clarified, the big question is, what are people actually doing with their Amex cards? What spending trends are driving this?
Well, what's fascinating is, despite all the economic chatter out there, American Express is seeing very consistent spending trends from its card members.
Really? Stable?
Yeah, remarkably stable. And interestingly, their data shows that stock market ups and downs haven't really swayed spending patterns much.
That is surprising. You'd think market volatility would make people pull back a bit.
You would think. It almost makes you wonder if, for some folks, especially maybe younger ones, the credit card is like a keep calm and carry on spending tool, regardless of the news cycle. It's an interesting disconnect.
Huh. So, okay, drill down for us. Which categories are showing this strength?
Sure. So goods and services, G&S, that's the big one. Over 70% of their total billed business. That showed really robust growth, 8% in Q2.
8% on the core spending. That's solid.
Definitely suggests that core group of cardholders is still spending strongly, maybe defying some broader economic worries, at least for this segment. Then there's travel and entertainment, T&E. That grew 6% in Q2.
Still growing, but a little slower than GNS.
A little slower, yeah. There was a modest deceleration there, mostly driven by a bit of a slowdown in airline and lodging spend.
Okay.
But, and this is key, high-value lodging transactions are actually up. And restaurant spending, which is the biggest chunk of T&E that continues to show really strong growth.
So maybe fewer trips overall or slightly cheaper flights, but when people travel, they're still going for nice hotels and definitely eating out.
Seems like it. A nuanced picture, like you said. They're prioritizing certain experiences.
And who's doing all this spending? Any particular group standing out?
Yeah, here's a really powerful insight. U.S. consumer services billed business grew 7%, and a huge driver of that. Continued strength from millennial and Gen Z card members.
Interesting. So the younger generations are really engaging with the brand.
Absolutely. It indicates their premium products, the value props, are resonating with those cohorts. They're locking in that loyalty early. And globally, international card services saw impressive growth too, 15% or 12% if you adjust for currency. Strong growth everywhere outside the U.S. Commercial side saw modest growth too.
Wow, okay. So strong domestic growth led by younger spenders and really strong international growth too. That paints a pretty clear picture. Let's shift gears slightly. Why are people spending? What's the product and experience strategy behind this?
Right, the why. It really connects back to their growth strategy. They acquired 3.1 million new proprietary cards just in Q2.
3 million new cards, that's a lot.
It is. Shows really high demand for their premium products. And that feeds directly into net card fees, those annual fees people pay. Those fees jumped 20%.
20% increase in card fees. Wow.
Yeah, driven by all those new cards, but also strong retention. People are sticking around, and their constant cycle of product refreshes.
And I heard they're refreshing some big ones soon.
Exactly. They've announced major updates coming to the U.S. Consumer and Business Platinum cards later this year. It's all part of a deliberate investment in loyalty.
So they're spending money to make money, basically, investing in rewards and services.
Precisely. Their expenses on things like card member rewards, services, business development, those actually grew a bit faster than revenues. But that's not necessarily bad. It's a strategic choice. They're leaning into the premium side, enhancing value to boost engagement and keep people loyal.
And that premium experience, like the airport lounges, that's a huge part of the Platinum appeal, right?
Oh, absolutely. The lounge game is critical. They're actively making their lounges bigger, offering priority access. They know it's a key touch point.
I heard about some innovation there, too, like a sidecar lounge in Vegas.
Yeah, like a speakeasy kind of lounge, someone described it. For quicker visits, it's pretty clever.
Yeah.
Shows they're thinking about different traveler needs. And they work really closely with Delta, too, in many airports.
It's interesting how that focus on lounges even benefits the airports themselves.
Right. It's been called a boon for airport authorities because it attracts those high-spending travelers. It's a whole ecosystem.
A great example of investment creating value all around. So, sticking a strategy, how do they see the competition? Are things heating up with Chase and others refreshing their cards?
It's interesting. While competitors like Chase are refreshing products, and, Citi hasn't announced major plans yet, Amex apparently feels the overall competitive intensity is actually less intense than maybe a decade ago.
Less intense.
Yes, yeah, that's the perception shared. Maybe less hype around new card launches compared to some past upgrades. Perhaps it suggests the premium market has matured a bit. It's less about just flashy new features and more about the established ecosystem and loyalty.
So more strategic positioning than an all-out features war.
Seems like it. And their marketing reflects that. Marketing expense was up 5% in Q2, but it's very targeted, aimed squarely at acquiring and keeping those high-spending, high-credit quality customers who really value the Amex brand.
Right, nurturing that specific, valuable segment. Okay, let's peek under the hood then. Credit quality, financial stability, how are things looking there?
Pretty solid. Total loans and card member receivables, they increased 7% year over year. That lines up nicely with the growth in spending we talked about.
So lending is growing responsibly alongside spending.
Exactly. And more importantly, the credit performance itself remains exceptionally strong. Net write-off rates, delinquency rates, they're stable and described as best in class.
That's good to hear, especially with economic uncertainty always lurking.
Definitely. It's supported by that premium global customer base they target and just disciplined risk management.
What about setting aside money for potential losses, the reserves?
Provisions for credit losses, those did increase, mainly because they built up their reserves a bit more this year compared to last year, building a buffer.
Okay.
But there's a specific detail here. They reclassified about $1.6 billion in loans related to the Amazon Small Business Co-brand portfolio. Move them from held for investment to held for sale.
And that affects reserves how?
That accounting change actually released some reserve. So the overall increase in provisions includes that offsetting release. It's a bit technical, but it impacts the final number.
Got it. Technical, but important for the full picture. So, okay, we've got financial strength, good credit, smart strategy. But these giants always operate in a super complex world of rules and legal stuff, Ray. Let's talk about navigating that landscape.
Yeah, this is a huge piece of the puzzle for any major financial institution. Amex faces extensive and constantly changing government regulation and supervision all over the world.
And compliance isn't cheap, I imagine.
Not at all. Substantial costs just to keep up. And the scrutiny keeps increasing. For instance, late last year, Amex became what's called a Category 3 firm.
Category 3, what does that mean practically?
It basically means regulators see them as more systemically important. So they face heightened requirements, more capital they need to hold, stricter liquidity rules, tougher stress tests to make sure they can withstand shocks.
More oversight, bigger safety buffers.
Yeah, exactly. Ultimately good for system stability, but definitely adds complexity for Amex.
And how does regulation hit their core payments business? Things like fees.
Yeah, that's a critical area. Payments regulation is a constant challenge. There are ongoing efforts, especially outside the U.S., to cap interchange fees.
That's the fee the merchant's bank pays to Amex on each transaction.
Correct. And those fees are a big part of Amex's discount revenue, what they earn from merchants. So caps directly hit their revenue. There was a specific EU court ruling about caps for co-brand partners, like airlines. It creates uncertainty, potential disputes. It can even affect their ability to keep those partnerships going.
Right. And what about things the merchant does, like adding fees for using certain cards, surcharging?
Yes, surcharging. It's definitely an adverse customer experience, as they put it, and it's increasing on Amex cards where it's allowed.
Because Amex fees are sometimes perceived as higher.
That's often the perception, yeah. So some merchants might single out Amex for surcharges. There's also concern about merchants steering customers away from Amex or treating it differently, which obviously isn't good for card usage.
And the legal battles never seem to stop either, do they? Antitrust is always bubbling up.
Always. They're still dealing with ongoing antitrust litigation. A lot of it centers on those rules about anti-steering and non-discrimination in their merchant agreements. Can merchants encourage other payment types? How?
It's complex.
Any specific cases?
Well, there are several ongoing ones, like Pizza Hazel, Five-Star General Store. They did reach a settlement in principle in an older case, B&R Supermarket, about the shift to chip card terminals. But the key takeaway is the potential cost. For some of these outstanding cases, the estimated possible loss, on top of what they've already set aside, is anywhere from $0 up to $210 million.
Wow, that's a wide range, but potentially significant.
Absolutely. And that doesn't even cover all litigation. So managing legal risk is a constant. Plus, you have all the modern risks.
Like cybersecurity, data privacy, dockets. Exactly.
Yeah.
Increasing focus on privacy, data protection, responsible AI use. And cybersecurity threats are relentless and getting more sophisticated. Think AI-assisted deep takes, complex attacks. Financial institutions are prime targets. It requires huge ongoing investment in defense.
So a really complex web of challenges. Given all that, plus the need to invest heavily, how robust is their actual financial foundation? Let's talk capital, liquidity.
Fundamentally very strong. Their capital position is robust. They're keeping their key capital ratio, the Common Equity Tier 1 or CET1 ratio, right within their target range of 10% to 11%. That's a healthy buffer.
And they're still returning cash to shareholders.
Oh, yeah. Returned $2.0 billion just in Q2. Mostly through share buybacks. They bought back about 4.7 million shares, and also through the regular dividends.
Where's the money coming from to fund growth and shareholder return? Debt.
They use a mix. They did issue about $13 billion in debt in the first half of the year. Yeah. But a really interesting and huge piece is their deposit program.
Deposits, like a regular bank.
Exactly. Through their U.S. bank subsidiary, American Express National Bank, or AENB. As of mid-year, they had something like 3.6 million accounts, holding almost $150 billion in customer deposits.
$150 billion in deposits. Wow.
That's massive, and about 92% of that is FDIC insured. This gives them a really stable, diversified, and pretty cost-effective source of funding, much less volatile than relying solely on wholesale markets.
That's a serious financial bedrock. So overall, cash flow looked good for the first half.
Very good. Net cash and equivalents increased by over $17 billion in the first 6 months, mostly driven by that strong deposit growth and the proceeds from issuing debt. So financially, yeah, they look very well positioned despite all the complexities we've discussed.
What an insightful deep dive that was. It really feels like we've unpacked a lot. We saw Amex showing strong revenue growth, really fueled by consistent consumer spending, especially from millennials and Gen Z.
Right, and those strategic investments in premium products, the lounges, the card refreshes, clearly paying off in loyalty and those fee revenues.
Plus, maintaining that really strong credit performance, which is key. And then navigating that whole complex world of regulation and legal challenges, which they seem to be managing carefully.
It really paints that full picture, doesn't it? How a major player like Amex doesn't just react to the economy, but actively shapes its own success through strategy and really knowing its customers.
So, thinking about all this, what does it mean for you listening? Given that consistent spending, especially by younger folks, the tech evolution in payments, plus all that regulatory focus on data and AI, how do you think our relationship with financial products, with loyalty programs, might change over, say, the next 5 or 10 years?
That's the big question, isn't it? Will that desire for premium experiences keep outweighing concerns about data privacy, or could new payment models totally disrupt traditional loyalty loops?
What stands out to you about the future of how we pay, how we pursue loyalty and rewards? Maybe something to think about reflecting on these trends in your own financial choices.